Ladies and gentlemen of the crypto space, we're live at 11:51 a.m. on a Thursday, March 11th. A little late today, gotten a little other minutes. Busy. Try my best, but I'm here with you guys. We got some stuff to talk about. We got to figure things out. We got to make better decisions, and that's just the topic of conversation that I always like to entertain. How to do better. Every chance, every opportunity we get to do better is worthwhile to take. Too many folks just buy things, and there's so much risk. First step is to understand how much risk you're taking, and that's really where I want to reapproach this topic. We've talked about it before, but we need to talk about it again. Risk on, risk off balance. How much is too much? Today's episode is sponsored by Change Angel, the non-custodial swap exchange for social goods. Stop depositing on exchanges, not your keys, not your crypto, non-custodial, DeFi, or nothing at all. Bam! Let's pop it over to the main screen and see who's in the stream. The Digilight in the house. Noah, my man. Theta is looking good, baby. There is a macro story. Future of shared broadband plus smart contracts with T-Fuel and gas. Sure, fundamentals are great. So, if you look at the chart, you're going to see exactly what you see with other or, not macro assets, but volatile assets. It goes up and down. That's risk. Something goes up 40%, it comes down 50%, goes up 30%, comes down 20%. Man, that's tough to stomach a portfolio going up and down. What if there's a better way? What if there's options and choices nowadays that never existed before? So you don't have to watch your portfolio go up and down and up and down. Maybe you could just watch your portfolio go up and up and up and up only. What would that mean? Kind of changes how you think about what you purchase. If there's ways to just watch your portfolio go up and not down. How about them apples? RR in the house. Chetan Patel in the house. Always a pleasure, my brother. 14 people in the stream, 3 likes. We can do better. So this is for the fun of it. We got 1 inch on the screen, 1 inch on. I think it's one of the more undervalued AMMs, obviously along with Curve. Very volatile asset. This thing was up at 5 and change, it's down at 398, and clearly was down in 160. This is a massive triangular formation with lower highs and higher lows. I want to own it. I have owned it. I've owned it recently. I can't stomach the risk. I can't stomach it. It goes up and down. When it breaks out, I'll probably ride it up. I'm not going to ride it down. Love the asset, just like I love many assets, just like I love Digibyte. I'll ride it up. Not going to ride it down. Doesn't make any sense. So I can't hold it. I don't have it. When you see an asset like this, it's going to appreciate likely substantially at some point. You wait for a breakout. You watch it on the long-term time frame. You watch the long-term moving averages. You wait for a break to the upside, and it goes up, 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 up. Get 50%, 100% out of it. Yay! But you can't hold it unless there's DeFi tools and functionality available to facilitate up only. What is this up only I'm talking about? Changes everything. We'll get to it. Let's take a look at YFI. This is also a big deal. This orange line is a long-term series of lower highs, and this was a breakout above, but you also have this other falling wedge that has emerged over the last couple days. So this is a relatively bullish situation. Right now, it bounced off of this long-term orange line, which is really cool. But and it's above the resistance of the falling wedge, in my opinion, but it's below the 200 EMA and the 200 SMA. This is another extremely volatile asset. It was up at 40 and change. Now it's 37. I mean, that's not a massive difference, but look where it was previously. This thing was up much higher. 50 grand, give or take, upper 40s. You watch it go from 47 to 37 and you watch your money disappear. I don't want to watch my money disappear. So how do you do up only? Up only makes all the difference. Watching your portfolio just go up. It doesn't go down. Whoa! Now, bear in mind, I'm not fully up only. Clearly, can't do this stuff, these DeFi plays with Bitcoin. He can't do it with Cosmos assets yet, or Polka Dot assets. So I take my fair share of risk. But what if the vast majority of the portfolio is up only? I know. I'm probably getting annoying at this point. Noah, tell me what the heck you're talking about. Let's look at Ethereum and Bitcoin first. Looks strong, but this is one of the assets that you could configure in up only. I like up only. It's volatile, goes up and down. I don't want to hold an asset that's 2,000 bucks and goes down to 1,300 and lose 30% of my money. You know, you got a 20 grand portfolio, you got 10 grand in Ethereum, and you watch the 10 grand turn into 7 or 6. Nobody wants that. Bitcoin, well, this was a heck of a dip. 50 and change down to 47 grand dip. You own a Bitcoin, you lost 7 grand. That's no fun. This is a very bullish trend formation in most regards. It could easily do mean regression down to this congregation of long-term moving averages. Worth mentioning. It's something that I posted on Twitter the other day. We could, upper 50, 51, 52, something like that. Let's go through the stream. Lewis is in the house. Always a pleasure. Just chugged 96 beers and I'm driving 178 miles per hour while texting you live. That's too risky. No good. Less risk. Music Affair, always a pleasure. Frank in the house. And hello, Noah and Crypto World. Happy birthday, Chat. Chat, birthday. Birthday wishes. Always a pleasure. Dirty Sanchez, regarding your tweet today about Ethereum, Aave, then depositing on Curve, then Yearn, how much capital do you think is necessary to make this profitable gas price? Depends on your portfolio. Everything is subjective. But that's up only. Sit on it for 2 years and watch it just go up. That's the up only play. I'll show you guys real quick. So you're going to want stable coins because it has to do with the borrow rate versus the deposit APY. So if you deposit Ethereum into Aave, it's not going to work because the average yield is 0.29% and the borrow rate is 3.81 on the stable side. So what you want to do is deposit dollars, stable coins, which will give you 10%, and then you can borrow Ethereum at 3.81%. One, that means your collateral, your principal, is growing faster than your debt. So it's a self-paying loan. And two, you're borrowing Ethereum, an asset, at 3.81%. You go over to Curve, you pop it in the SF pool. It's not going to get much, 0.34%, but that's where Yearn comes in. And here's the SF pool yielding 27%. So it automatically compounds. So there's your gas fee solution. The pool automatically handles gas fees and compounds for you, yielding 27 and change percent. So let's say it's 25 and it drops a little bit. So you're getting 25% on your Ethereum with interest denominated in Ethereum. So your Ethereum quantity, the quantity of Ethereum, not the price of Ethereum, is going up. Let's say you borrow 5 Ethereum. In a week, you have 5.01, 5.02, 5.03. Eventually, you'll have 6 Ethereum. Your interest payment is 3.81. So you borrowed 5 Ethereum, 5.001, 5.002. The quantity of Ethereum you owe is going up at 3.81%. But the quantity of Ethereum that you're earning in interest is going up at 27.9%. Your debt, your interest is accumulating faster than the debt you owe. And since the debt you owe is denominated in Ethereum, all the interest above and beyond the debt accumulation is your Ethereum. Doesn't matter the price. You got it as interest. Up only. That's how you do up only, ladies and gentlemen. That's the sequence. Portfolio doesn't go down, at least that part of your portfolio. So why take so much risk when the vast majority of your portfolio can be in up only mode? So you could do that with dollars also. So but the problem is interest rates have spiked, so you're not going to be able to get a decent, stable APR. Um, just distracted. I got some work people talking to me. But this was like at 8%. I had a bunch of US dollar debt at like 8%, which is really cool because the 8% is less than the average interest on the principal on your collateral. So you could throw that into GUSD, 44%. So you got a loan at 8% interest, but you're making, let's say 40%. Let's say the interest goes down a little bit. You're making 32% on your dollars. So it works with dollars, but the kicker is, I had those positions. I pulled out of them and I repaid dollar loans at 8% interest. And, you know, now it's 23% interest. So I think about that. Maybe I should have held on to those cheap dollars with that locked in cheap interest rate. But you know what's cheaper than 8%? 3.8%. And the interest on dollars being, let's say, 40%, 32% minus the 8%, um, was just dollars, stable. The interest here on Ethereum being, I owe, let's say it's 4% and I'm getting 25%. So I'm getting 21% growth on Ethereum. The interest is Ethereum, which is over a year or two is going to likely asymmetrically appreciate through the roof. So this was the logical play. I had a bunch of debt in dollars. I flipped it. I repaid the debt. I flipped the debt position into Ethereum. And that's where I went with the play with two pools. Curve STF, which is an incentivized pool. But, I didn't want to put everything in one pool. Diversify. That's what I did. Curve SF, another 27 and change percent. And I threw a little bit in the WF pool for 14%. Can't be greedy. Stop going for 1,000%. That's how you lose your money. That's why BSC is a garbage heap. You want real interest derived from sustainable sources, which is most likely transaction fees, or incentives, which is the Curve STF position, which is incentivized by obviously Curve monetary policy, but also ST Ethereum monetary policy as well. They have their governance asset. This is just interest and Curve monetary policy. There's no third party, other than synthetics, but synthetics did not incentivize the pool. So these are very different pools, very different properties. This is probably not sustainable for another couple of months because of the STF incentive. This is probably sustainable for a longer period of time, and this is just sustainable because this is the Ethereum pool. That's the deal. That it just goes up. No, obviously I have my other positions, my risk on positions, but I've substantially trimmed them. As of right now, 50, 60% of my entire portfolio just goes up. Stop taking as much risk as you're taking. You'll thank yourself in the long run when the market goes down because you don't know that it's going to go up. You don't know when it's going to go down. But markets go up and down. Sure, you can think about it from a longer term time horizon. Bitcoin appreciates at 200% per year annualized over the last 10 years. Cool. You can't do this money game, this up only with Bitcoin, but inherently Bitcoin kind of does up only by itself. Just hold the Bitcoin. Throw it in Celsius, BlockFi, get 6%. Borrow dollars, pay taxes like I talk about. Some people don't like the centralized exchange, but I think they're going to be some of the biggest corporations on the planet, BlockFi and Celsius. They're just going to draw in capital all over the place. I think they're a big deal. So not too worried. No risk, no gain. 6% isn't much, but I think the benefit of those platforms, particularly Celsius, is 1% dollar loans at 25% TVL, LTV, loan to value ratio. That's very useful. Come on. So measure your risk. Is it worth it? You have to be able to sleep at night. So if you're afraid the company's going to go bankrupt, don't put it in there. And you'll get 200% per year on average. Or maybe you need access to the capital. Bitcoin went from 3 grand last year to 50 grand. Maybe you want to borrow 25 grand to buy something and you could pay back $500 a month for the next 4 years. That's exactly what it's for. That's the whole point. And that's the way wealthy people use their money and use their assets. All right, let me get back to the stream. I don't want to miss too many comments. Also, how about alts where you need to deposit only one platform, BNT? So those are asset quantity stable. So Bancor is a volatile asset. It will go up and down substantially. Asset quantity protective is not up only. Bear in mind, where's my Bancor? I'll show you guys the Bancor portfolio. It's all dollars. It's all dollars. It's up only. I mean, you can't go wrong with up only. I got some Bancor, a little bit of Bancor, but Tether, DAI, USDC, a little bit more BNT. I rolled over the interest, and some alpha. I think there's much potential for alpha. I usually don't have large risk on positions, and this is a perfect example. This was not purchased for $50,000. This Bancor I think I got for like 4 grand or 3 grand. I mean, at the beginning of the March of 2020, Bancor was like pennies, 25, 30 cents. I don't buy large risk on positions. Don't take the risk. Buy if you're tempted to buy 50 grand with a Bancor, stop yourself. Buy 5 grand, 90% less, and put the rest in dollars that are earning 100%. Getting 100% in your money. DeFi is disrupting the crap out of legacy finance. You're getting 141% in your Tether for the next 27 days. 124% of DAI and 100% USDC. Oh my goodness. Oh my goodness. You could get 100% in your dollars, and your folks are buying volatile assets that go up and down. You're trading guaranteed up for maybe up, maybe down. Take a step back. Take less risk. Protect yourself, protect your portfolio. Respect your portfolio, and it will respect you. Smash the like buttons, everyone. We got 30 people in the stream, 14 likes. We can do better. Glady says, hi, Noah. The TVL on 1 inch went down significantly yesterday. It went down because of the liquidity mining, the incentives on their pools finished. It wasn't yesterday. It was a couple of days ago. That's what it was. It went down. Not a bad thing. I like my 1 inch a lot. I think the platform has a great deal of potential. The problem is it's risk. So maybe when this breaks out, you guys see the cash I have over here. There's a bank. I got cash. I have plenty of cash. So, maybe this breaks out and I buy 5 grand worth. Small, tiny. The 5 grand turns into 50 grand. I win. I don't need the 5 grand to turn into 5 million. That's how you lose, because it's not going to happen. It's going to go up and then it's going to come down. Stop taking big risks. 1% of your portfolio, 0.5% on risk. Less risk, more up only. Up only is how you're getting 100% of your money, 30, 40, 50% of your money in other platforms. 10 years and 20 years, they talk about compounding in legacy finance, which is done because you're not getting jack shit from a bank at 0.0000001%. And treasuries are useless at 1.5%, whatever the hell's going to happen with them. The economy melts down or not. But at 100% compounded, yeah, I like my odds. 10 years, 20 years. You know what's going to happen to the capital? Psh, that's the name of the game. Squanchy says, "What's up? Beautiful to watch your stream grow, sir. You're doing God's work. I thank you very much. I myself am on a journey of doing better and taking less risk and perfecting up only, and capitalizing on the volatile assets because you got to wait. I've learned patience. I have my assets I like. In fact, I thought YFI would break out. I bought it. I sold it. I'm not going to sit and watch it go left and right, horizontal. I'm going to wait for it to break out. And then I take a small position. That's the name of the game. Um, Igor says, "Hello, Noah. What is happening with Blocknet?" Yeah, Blocknet's partnering with Avalanche and doing some fancy stuff. It's a big deal. I don't fully understand the extent of the work being done, but I see they're doing some serious integration. Web-based. This is awesome. This is going to be DeFiification of Blocknet, albeit Blocknet was DeFi before, just at the UTXO level. So how they're going to merge the platforms and bridge the functionality. Whatever it is, the Blocknet team has never ceased to amaze. They are brilliant, and they have been diligent over the last years, not months, not year, as with DeFi and reaching critical mass, but years they've been developing. I remember their first atomic swaps. So, love my Blocknet. Are you taking excessive risk? Watch your risk because we have up only. Hard choices, but take less risk. Easy like Sunday morning, Trevor. Yeah. Just curious, do you have a finance background or are you self-taught? Fully self-taught. I did this all myself. Lots of Google searches, lots of, it's mathematics and percentages and just figuring out how much I'm earning versus how much is my debt accruing, at what pace, and the products that are available. Look at this, 165% on YFI. I would be in there real quick if there was a stable rate for Yearn on Aave, but I don't would never borrow at a variable rate APR. I don't trust it. It's like getting an adjustable rate mortgage. Never. Get a stable rate. This shot up to 24% to borrow, 48% for USDC. I got mine at 8% and it was locked in. It's a stable rate, 8%. Stable. Just got to wait for it to come down. And that's how you get capital. Carlos, what are the risks of liquidation with an ETH spike if you borrow? Why are you providing Ethereum as collateral? You provide dollars as collateral. Stablecoins. Zero chance of liquidation. Stablecoins are stable. You see? And you borrow stablecoins. And frankly, Ethereum is a no-brainer. So many people are providing Ethereum as collateral because they want the full upside of Ethereum and the full risk that the stable rate is 3.81%. It's so cheap. And being risk adverse, I am able to take advantage of other people's risk appetite. So other people are taking significant risk holding Ethereum, and I'm taking advantage of that to borrow it from them at a very cheap rate using stable assets that earn significant amount of yield that have basically no chance of liquidation as collateral, and I'm able to earn double-digit interest on my borrowed Ethereum. So basically, my collateral is growing faster than my debt. So I have self-paying loans, and my debt is producing free Ethereum, up only. So why own Ethereum when you can get free Ethereum? I'm just saying. So that's the name of the game, Carlos. Music Affair. Well, stables are just the half. Are just the half now, just 50%, but still good. Well, yeah. So if you're talking about like portfolio balance, that's the whole point. I mean, stables are extremely powerful for a strategically implemented portfolio, and that's just what it is. Have stables and use the stables to gain access to volatile assets, because your stables are stable and are getting double-digit interest most of the time, 19% on USDC. Oh my God, with an average of 11%. Double digit, up only, used to get debt, double digit, up only, or you buy assets and you watch them go up and down, and you watch your portfolio go from 5 grand to 250 grand and back down to 75 grand. And I don't have the stomach for that shit anymore. I'm not 25 years old anymore. I don't want to wait 5, 10 years for another market cycle. It's not happening. So up only is the name of the game. Um, Still some of the best in the industry. Not familiar with what you're referring. It's all good. Hey, Noah, recently found your channel and love what you're doing. Sorry if you have covered this in the past, but have you looked into Mirror Protocol? Those are the synthetic assets. Cool. Synthetics, Mirror, good stuff. I would never own it. It's volatile. I'm not going to watch assets go up and down. I'm going to wait for a strategic DeFi scenario to be available where I could use collateral to leverage a debt position that's one, self-paying, two, the debt position earns interest greater than the cost or the rate in which the debt accrues. Debt accrues. Period. If you buy stable coins with dollars and borrow ETH against them, how come you still get the interest on the stable coin? Because that's the way Aave works. Do they still pay interest if borrowed against a stablecoin? Yes, because the stablecoins are still deposited, and that's the way Aave works. Aave might be one of the best money markets debt systems I've ever seen. Absolutely the most useful system I've ever seen. Staking? What is staking? Staking, it's not UTXO staking. That's what people usually refer to when they're talking about staking. So staking is very different in DeFi and Ethereum and other smart contract platforms. What's pertinent is the monetary policy and where those emissions come from and whether that inflation is sustainable. And we've talked about that, where the inflation is coupled with deflationary components and burn components. So you have stable growth. You don't have extensive debasement like we had historically with the Mastinos back in 2018. Million percent. And that's exactly what's playing out in BSC in most part. It's just unsustainable monetary policies. We're talking about stable pools on Bancor. The LM is just half was displayed, so you're getting around 50% now. Okay, that sounds good. Wait for it to get 2x. Wait a week or two, and it goes up, what, 25% per week? 20, you go increase 0.25 each week until reaching 2. Cool. That's awesome. Sounds good to me. I'd buy that for $1, that old Robocop slogan. You guys know what I'm talking about. All right. Okay, so where are we with up only? I'm going to end on this note. I got some work to do. Uh, the only risk in that scenario, one, is obviously the balance. It's called the cash and carry trade in legacy finance in many regards, where you're earning interest more than your debt is accumulating. So if that fails, meaning all of a sudden your interest is less than your debt uh, rate, um, you exit the position. So one and two is the smart contracts, and that's where Nexus Mutual comes in. Get a contract, an insurance contract if you want. You feel you're taking excessive risk, you get an insurance contract, and that's how you cover the risk. The whole game here is risk management. And there's risk, obviously, in just taking a position, but there's also risk in holding a position, especially when interest is involved. So if you feel you're taking risks that you're not comfortable with, that's exactly where Nexus Mutual comes in. That's the bottom line. Yeah, a lot of bottom lines, and that's the deal statements. I say that too much. But let's wrap up the stream. That covers the bases. We talked about a couple of assets, looked at some technical data, looked over Aave, talked about Blocknet. I think they'll come out swinging sooner or later. And Bancor is just an absolutely incredible monetary policy. Trevor says future inputs to Bancor automatically take your initial deposit multiplier to. Sure, okay. Things to consider. Mickbon, crypto people are everything for everything trustless, so they feel they need to Disclaim smart contract risk when telling new people, but people don't understand this. They see 40% interest and declare crypto a scam. Yeah, the 40% interest, the vast majority of the time, is denominated from transaction fees. Um, Double-digit gains easily from transaction fees. And if you're talking about incentivized gains from monetary policy, sustainable monetary policy, uh, yeah, there's definitely double-digit gains available in the crypto space. So scam, yeah, they just don't understand. I've been in this for about a year at this point, and the sustainable platforms have emerged. Critical mass has been achieved, and we know what the DeFi majors are. Now, I stick mostly to the DeFi majors. They're smaller players that experience minor issues. Alpha handled their security breach very well. They are paying everything back without insurance, and they did it very intelligently. They talk about it in their Medium posts. It's pretty cool. Very smart people, and the entire community learns from the experience. All the major DeFi programmers and platforms. Are rewards you earn on Banker going to be the same as the liquidity that you provided? No, there's two parts. So it's incentivized yield, but from their monetary policy. Look, for instance, DAI BNT gets 7.38% weekly average, but you're getting BNT, the vast majority of the yield. So it's like 120% yield denominated in DAI, in Bancor, and then 7.38% denominated in your collateral. So that's the way that works. And that's what Yearn solved with Curve, is they automatically take the incentivized yield and they liquidate it. So you're earning in the currency that you provided as collateral to the protocol. And for a while, this was a very inflationary pressure on CRV. But then the deflationary component, the deflationary feedback loop really kicked in strong, and Curve went from 20 cents to $3.50. It's hovering probably around two and change at this point. No, music, you get more. You get interest on your collateral. It's just not high double digits and triple digits. It's usually single digits for most assets. So there is yield on your collateral. Just worth mentioning. All right, 12:23 p.m. on March 11th. Thank you everyone for joining. 35 people in the stream, 22 likes. We can do better. I wish you all a wonderful day. Take less risk. Think before you act. Assets are volatile. What goes up comes down. Over enough time, sure, they probably go up more than they come down, but I don't want to watch them go down at all. Something special about up only mode that's now available in the DeFi space. Watch your risk. Think about insurance and do better. Could always do better. I thank you all for joining. I'll see you tomorrow. Tomorrow's Friday. You all have a good day now. Peace.